Welcome everyone to the Spaces with Blue Jay. We do this on a weekly basis where we bring on protocols in the real asset lending space so we can learn a bit more about people building this, especially this sector and the infrastructure layer where we had other protocols like Quadrata, Credora, working on the infrastructure layer of RWA, and today we have Huma Finance, both from Huma Finance, who covers a brand new way to collateralize for crypto lending, which I think is very interesting and revolutionary. But yeah, welcome Erbo, and thank you for the opportunity to speak with you guys. Yeah, to just kickstart the questions, maybe tell us a bit about your founding journey as the co-founder of Huma Finance, and what inspired you guys to start a lending protocol that focuses on income-backed loans.
Thank you so much, first of all, for having us. It's great to be talking about these topics that we believe is the future of DeFi. And I'm here joining on behalf of one of my co-founders, Richard, who was supposed to be on the call, but there's a last-minute change of events. We started Huma Finance, so it was myself, Richard, and G from a previous fintech called Earnin, where I was the chief product officer, Richard was the chief technical officer, and G was the head of risk and machine learning. And Earnin was the pioneer in the United States for cash advance fintechs. It's called earned wage access when people are having trouble making ends meet, especially the people who doesn't have a lot of credit or maybe no credit at all. We built a fintech that was non-predatory, 0% interest rate, non-recourse, and it was all purely backed by the income predictions we have made. So we would look into how people are making income, how they're earning, and then we would have very accurate descriptions of that income, and we would be able to lend in a very responsible and sustainable way. And as people paid back their cash advances automatically from their next paycheck, they would have higher and higher access to more credit. And this way, we were able to serve people who didn't have any other option. And we served more than 10 million people in the United States. We originated more than $15 billion in cash advances with less than 1% loss rate. So as you can imagine, what the risk loss rates are in that domain with that audience, we were doing something magical. And that inspired us to do this at a much wider scale. So myself, Richard, and G left about a year and a half ago to basically think about what does it look like at the global scale. Because when we were looking into DeFi, we realized that a lot of the DeFi lending is purely based on collateralization of a few digital assets. You need to have lots of Ethereum, you need to have lots of wrapped BTC to be able to create a margin loan, to be able to speculate and trade on that. But what if you actually just need something that's more like a car loan, something that's more like a business loan, something that's more like a personal loan, right? That's more like a credit card. What do you do? What you need to do is basically prove your income, just like it happens in traditional finance. When you need any of those loans, the first thing the underwriter looks at is what does your income look like? We decided to build this, what we call the missing primitive, the income primitive, so that we can collateralize any income-like asset, either on-chain or off-chain, right? So we can collateralize any of that and lend against. So that's the start of Huma, and we went to Ethereum Denver to build an MVP last year. We were a DeFi track winner, and that gave us the confidence that this is what the ecosystem needs, and we started Huma.
Wow, that's really amazing, especially with how you guys started with Earnin. And yeah, that really it's almost like a smooth transition from web to looking into how on a global scale you guys can provide these income-backed loans. And yeah, Web3 seems to be the answer for that. And yeah, that's a very interesting way as to how you guys approached crypto lending. Can you also share a bit more on your seed round fundraising process? Because like I understand when you guys raise, it's probably during the bear market of crypto, which is which for most of us would be fairly difficult to even get money from VC. So how's the process of that?
Yeah, so to be honest, we've been lucky because when we raised, it was just the beginning of the bear market. And we announced the fundraise last month because we also announced our public beta last month. So now Huma is open as public beta, and we announced the raise. But the raise was done mostly last year, just at the beginning of the bear market. And I wouldn't say it was very easy, but we were lucky because after winning the DeFi track at ETH Denver, people saw the team leaving earning, and we are known entities, and people, especially in the VC industry, know us by name or personally. We were offered a few very attractive term sheets, and we were able to close it in a matter of 3 weeks. And I don't think if we started raising today, it would be that easy, or it would be the same result, or at the same rate or same amount that we would raise. I think it was a bit of a time, like a bit of the momentum of the ETH Denver, the excitement that comes with the community support from ETH Denver, and maybe being at the very cutting edge of technology and what's missing and our approach to building DeFi infrastructure, and our ability to actually show that we have been able to build such infrastructure in the past. I come from long time I spent at Facebook, where I built products for the next billion. Richard was at Google for 8 years. He was the head of engineering for a lot of innovative new products as well. So I think people trusted that we could build this thing.
Yeah, lovely. It's almost like a Avengers team. They got together and started Huma.
Like
You
that.
guys are really insane.
Like
yeah, your background is really that's really stacked. And yeah, I guess we can also get into the protocol itself. As like for Huma Finance, I know currently I guess retail crypto investors can't interact with it yet, right? For the launch app, it's only whitelisted for certain DAOs, or can you explain a bit on that?
Yeah, so we are still in private public beta, but it's not public yet. We're testing things out with the first set of partners. We have Request Finance launching the UI integration soon. We have Superfluid Stream integration launching soon. And then we have 2 other partners that's launching like more Web2 fintech integrations using our backend. So like fintechs doing small business lending in Kenya, in Philippines, in other parts of the world, launching on Huma. So as we're testing things out, we're still keeping it in public beta, and it's behind the LO list. So the lenders, depending on the fintech's interest, let's say I'm a fintech in Philippines, I might need to show KYC investors or KYB investors for my specific pool. So our protocol lets anybody configure what those pools requirements are, and a pool can also configure it and say, I'm going to open up the lender side to any retail investor as well. So it's kind of like a decision of the pool owner or the pool partner, because we're trying to be respectful of people's needs in terms of if they're like a fully compliant regulated fintech in some part of the world. So the protocol can work depending on their needs. And our plan is with V2 to open up more forms of both lending and borrowing for anybody in a pretty much permissionless way.
I see. So for currently, I guess the borrowing side is more for these fintech companies, is it, or can an individual already borrow based on?
It's a mix of both. So different pools support different collateral. So there's a pool that supports collateral or request finance invoices. So anybody who has a request finance invoice can come and borrow. And then there's a Superfluid pool launching soon. That's going to be anybody who has a Superfluid payment stream will be able to come and borrow against that soon. And then some pools are dedicated to fintech as well. So it depends on the pool. Each pool has a different collateral requirement.
I see. But so mainly there's three to begin with. Anyone who's using Request, anyone who's using Superfluid, and fintechs, which you guys are onboarding, are using your own BD go-to-market,
That's
is
right.
it?
That's right.
Okay, great. Yeah, I guess more on the interactions with Superfluid and Request Finance, because I guess for most of us individuals in crypto, when we want to lend crypto, we will use Compound, and it's very different from how we do it with Humai Finance. Maybe you can explain how it's different, in terms of maybe the flow, the user flow. So let's say depositing and how it look like. Yeah, if you can try to describe that for Humai Finance in comparison with, let's say, a typical one like Compound.
Yeah, it's quite different. I think that's a great comparison because I also started my DeFi journey using Aave, Compound, and Yearn Finance, and all of the non-DeFi protocols. And they are, you mostly look at the rate, and usually you need to have a blue chip crypto asset to be able to utilize those and for it to make sense for you. In our case, we start with, okay, what is the collateral? It's not ETH, it's not Wrap BTC. It is that income contract or income collateral in whichever form it might be. Yes, we started with request finance invoices, and maybe we can talk about that. So let's say I'm getting paid with invoices I provide to a DAO or provide to a Web3 company or provide to anybody through request finance, and those invoices have a representation on chain as an NFT that basically wraps the information about invoice, but more importantly, that NFT acts as a tokenized invoice. What it means is if I'm collateralizing my invoice NFT, I am putting that invoice NFT into the lending pool, and that lending pool automatically becomes the owner of the invoice. So if my invoice gets paid in a month's time, then the pool automatically gets paid because the invoice system that Request Finance integrated with Humai now knows that token, that invoice token is owned by the lending pool. So it just directs the payment to the lending pool, and my loan gets paid automatically the moment the invoice gets paid. So now I'm using this tokenized invoice as the collateral to borrow against, and my experience is a simple click on get paid now button either on the Request Finance interface or on the Humai Finance dApp. And that takes me through a few questions about what is the rate of financing, depending on risk factors like this invoice structure itself, our history between the payer and the payee, both on-chain history and some of the other invoices that we have exchanged, and are they getting paid, at which rate they're getting paid, are they getting voided. So there are a bunch of things that are evaluation agents, which are automated engines, look at to approve this on-chain borrowing. And everything else is, again, fully automated, the collection of the money from the invoice as it comes to Request Finance, and closing of the position, so I can just go and factorize more invoices.
I see. Yeah, that's interesting, and seems very seamless. You also did mention that you are collecting off-chain information for the income-backed loans. Maybe you can describe more on that bit as well.
Totally. So we have built the protocol with the most amount of flexibility possible, because we know that if you want to actually service people who doesn't have much crypto exposure today, if you want to service the next billion, you need to actually understand income not through their Web3 signals or their on-chain transactions, but you need to understand it from wherever that information is. And usually that's in open banking APIs, it's in some other forms of integrations with things like Stripe and other payment systems and billing systems. And we have built a protocol so that if we're working with a fintech that's launching a small business loan and they're using some e-commerce APIs to understand their commerce transactions to underwrite their revenue, we built it so that a signal adapter can be built to integrate that information into the protocol in a privacy preserving way. That's really important for us to make sure that each information is coming in a privacy preserving way, and the borrower has utmost control over authorizing what kind of data can be utilized for this underwriting. And no data is saved on the protocol. Everything is just utilized for underwriting. And the moment the underwriting happens, there's an on-chain record about this borrowers able to borrow up to a certain amount of money. So these signal adapters can be also written by anybody in the community. So we already have open source contributors to our signal adapters that are adapting different signals and income information from different vendors and APIs and services. And we're very happy to build this in a completely open way. The whole platform is open and most components are open sourced, including our contracts. And people are already contributing all these different signals so it can enable more types of borrowers, more types of fintechs to automatically underwrite a larger group of people, again, who doesn't have any crypto assets, who doesn't know how to use DeFi. So they don't need to go through intensive training and conviction. It's just they can utilize as another Web2 borrowing without even maybe knowing that they're borrowing from DeFi.
Yeah, that's really impressive and really makes it more scalable. Yeah, having to open source the contributors for the signals. And other than that, you also did, I do see that during the recent event that people were able to build on top of Huma Finance as well, like crypto credit. If you don't mind to elaborate more on those protocols building on top of you.
For sure. So yeah, when we announced the public beta at East Denver and opened it up last month, 22 projects were built on the Huma protocol. And we were, to be honest, so impressed because we are like the newest kid on the block in terms of sponsors. You have like Polygons and all the other big names in there as sponsors, and we were surprised with like how much people wanted to build on the Huma protocol. So out of those 22, one you mentioned is Crypto Credit is doing a very interesting thing. They are trying to solve the problem of cash ecosystems. In the modern world, we have went from a cash ecosystem to a credit ecosystem, a cash ecosystem to a bank ecosystem to a credit ecosystem, and now we're going to, into this DeFi ecosystem. So we're making this transition one step at a time, but there are parts of the world, and these are like very big parts of the world that are still stuck in cash ecosystems. They don't even have made the transition to banking because they don't trust that banking system, and maybe they have good reasons not to trust the banking system, seeing what's happening in the past few weeks. And some of them just don't have accessible banking infrastructure around them, right? So they are trying to figure out how do we leapfrog them into the DeFi ecosystem immediately. So they have this validator system where you can use real life validators. That's almost like a proof of stake system, real life validators that are staking to validate these real life cash transactions to create a record on chain that these transactions have happened, these bills have been paid, and those on-chain records that are validated by real-life validators are basically building them credit on-chain, and that credit can be utilized to borrow against the Huma protocol. So it's a very interesting use case. Just again, leapfrogging all the way from a cash ecosystem to a Web3 native ecosystem, and I think that's going to be a very successful use case. And then we have Joy Finance, ZK Joy. It's a ZK Sync-based account abstraction wallet that has a built-in credit line. So if you think about, what's broken about our wallet experiences today, a lot of it comes from the primitive of the EOA wallets being just too limiting. And with account abstraction wallets, you can actually create much better user experiences that doesn't require these seed phrases that we need to remember and can have social recovery mechanisms. They went further ahead and they created this highly privacy preserving ways of creating a credit line that's attached to your wallet directly. Instead of having a lending pool, you go and borrow, you have this credit line attached to your wallet. So it's almost like turning your wallet experience from a broken debit card experience to a kind of seamless credit card experience. And you can use that credit line to basically make purchases and close that account automatically through the user ops level policy. So it's like a mind-blowing experience. And there's, again, 20 other applications built on Huma. We publish a lot of these on the Twitter account, and I'm happy to go into more details about others as well.
Yeah, wow, that's really impressive. Yeah, but actually, yeah, both Crypto Credit and Joey Wallet. And yeah, crazy. You guys recently just launched public beta, and it's people building on top of you already. That's you guys are really accelerating growth. But yeah, really interesting to hear about how Crypto Credit works on cash ecosystem countries and how Joey Wallet has credit lines attached to the wallet itself, which revolutionary. Can't wait to see how they build on for the rest of the year. And I guess going back into more on Huma versus our previous crypto lending protocols. I guess most of our DeFi ecosystem currently relies on over collateralization. Maybe you can share about the limitations of that structure and how Huma addresses those issues.
Yeah, that's a great point. I think over-culturalization itself is fine, but the problem starts rising when two things happen. Is one, over-culturalization, like, is it actually creating a mechanism that only gives access to a fewer and fewer people, which has been the trend in DeFi, right? If you look at the story and history of culturalization ratios in DeFi, the moment we hit the winter and the bear market, the cultivation ratios obviously start increasing, but also the type of collateral you can bring in started to become more and more limited, right? There were probably a larger group of assets you could bring in as collateral, but a lot of those assets has been removed from the blue chip protocols, and now it's so limited, very high collateralization ratio, and basically when people really want to use DeFi, when all the other fintech infrastructure and the banking infrastructure is failing, DeFi is becoming more and more limited, and that to us doesn't really feel right. Like, how do you actually create access points that doesn't create a lot of new risk, or the risk can be justified with new type of pricing, right? I think it is the approach we're trying to take, where how do you keep the risk exposure limited, but have more flexibility on personalized rates and the pricing of different kind of assets, so that you can create these access points when people need it the most. And we start thinking, okay, like, what does it mean? What kind of collateral assets you can bring in? And we know not many people have a lot of Ethereum and a lot of BTC, but a lot of people have, again, this income type of assets, right? Either because we're getting paid as a salaried worker, we have payrolls, we have money coming in as rewards from DAOs, we are getting paid through our staking nodes that we're running, we may be getting paid through GameFi rewards, maybe we're just getting paid as a business through invoices in real life. And that's why we have these fintech partners that we're working with to tokenize those real world invoices and subscription revenues and e-commerce revenues. So all of these things exist as assets in day-to-day life for all of us. So what if we over-culturalize that? What if we actually over-culturalize those assets that people have, so we have more access points? And I think that other challenges when you over-culturalize just a few crypto assets, when you get to the point of liquidation, it just creates a cascading effect of failures, right? And we feel like that's almost too stupid for us to keep going back into every single winter into this cascading liquidations, just because we have not thought about other mechanisms to deal with these events in the macro ecosystem. And it's quite dangerous. If USDC really depegged, what would the impact of that be? There would be a cascading levels of failures across a lot of big ecosystems, including MakerDAO and other blue chip protocols. And that's something I think we should decouple ourselves from, maybe not immediately tomorrow, but slowly. And that will only happen if we can bring in other types of assets as collateral, but also if we find other solutions to how we deal with these macro effects in the ecosystem. And that's where we try to come in, creating this like shorter mid-term loan structures with personalized pricing and different kind of assets that we can underwrite. So that's how we're trying to deal with that.
Yeah, that's great. Yeah, I guess other than that, yeah, maybe you can also share more about the collaboration that you have with Circle, Request Network, and Superfluid. I understand you already covered like how you guys are working with Request Network and Superfluid. For Superfluid, is this income is the streams of payments, and Request Network is the invoicing. For Circle, how do they come in? Is it because you guys are mainly using USDC for the deposits?
Great question. So if you think about serving the next billion, especially those fintechs and small businesses that doesn't have a lot of exposure to Web3, doesn't have these wallets that they use every day, then you need a very reliable on and off ramp structure, and it has to be a very easy to use account for these fintechs and small businesses to utilize your protocol. And to build that for everybody in the world and for all of the emerging markets that we're serving ourselves is a crazy undertaking, right? It's how you do on off ramp. There's just way too many different solutions, different implications in terms of compliance and taxation, and we just didn't want to deal with that. And there's only one platform that gives you both the stablecoin but also the on-off ramp infrastructure that you can use as an API, or your partners and borrowers can use directly through the Circle interface. And we've been able to avoid a lot of heavy undertaking on our side by just depending on USDC being the on-off ramp currency, which also happens to be the currency of our lending pools. And also all of the infrastructure they're providing is super helpful for our partners to onboard immediately. Some of our partners can onboard in a matter of weeks, even if they haven't touched crypto before. That's like impressive. And that's mostly because of the infrastructure they are providing.
Yeah, that makes a lot of sense. Actually, for ourselves as well, we've been looking for ways to simplify the onboarding process where people put in capital for our own lending pools, and we've been looking towards different on and off ramps. But yeah, Circle totally makes, I guess it makes the most sense because they're compliant in most places.
That's right.
Or they're working on getting compliance there, and yeah, they have their own stablecoin. You can rely on it, and yeah, businesses can directly on and off ramp with their own interface. Really, yeah, it makes a lot of sense. And you guys are mainly building on Ethereum and Polygon for a start, right?
That's correct.
Are there any? This might be very early to even ask, but are you looking towards any other chains like ZK Sync or any of the up and coming ones?
Yeah, it's funny you ask about that. So during ETHDenver, the project that's start being built on Huma Finance, ZK Joy or Joy Finance, as you can find them on Twitter, they wanted to build this account abstraction based wallet with a built-in credit line. So it's a credit card like wallet, but they wanted to build on ZK Sync, and we were not deployed on ZK Sync, and they told us, what, we can do it for you. So they were at our hacker house at ETHDenver, and literally overnight they deployed our whole infrastructure on ZK Sync, and they were able to run that for their demo. It was like so impressive that they were able to do that. And that's one of the benefits of having an open source stack, right? Like all of our contract open source, all of our critical infra components are open source. And when you have it that way, the really good developers and engineers who are excited about bringing that solution to other ecosystems can do themselves. And like we only gave them maybe some information about how certain parts of the ecosystem gets together and how things should be configured, but otherwise they were able to deploy it on ZK Sync and use it on ZK Sync, and they're still building on that infrastructure. We ourselves decided to just start with Ethereum mainnet and Polygon, mostly because those are the ecosystems we started on, and those are the ecosystems where we have the first set of partners. And as we find other partners in other ecosystems, we will expand because the incremental overhead of deploying is not that high, but operationalizing it is not an easy undertaking, especially if you have a lot of components that is running in this ecosystem. So as we get better at running things in a full automated way, I think we will find ourselves launching on more ecosystems. But for now, we have more than enough demand, more than enough partners that we can't even support all of them, to be honest, with a small team. So I think we'll stay on Ethereum and Polygon for a while. And then after V2 of the protocol launches later this year, I think we will start looking into those other ecosystems.
Yeah, really glad to hear that you guys have a huge pipeline in terms of demand from borrowers and lending side. Yeah, also going to that. Yeah, I mean, and yeah, okay, yeah, just to touch on it, that's very impressive as well. That since you guys are open source, someone could help you build on zk Sync. That is crazy.
Yeah, we've been so
But yeah,
impressed
I
with
asked.
that team.
Yeah,
Yeah, that's right.
yeah, my God, and yeah, I just asked that question because now I guess it's the airdrop season ever since Arbitrum dropped, and everyone's just asking, oh, are you building a new chain, or if you're building there, maybe we can carry out some on-chain activity on yours and yeah, potentially get some airdrops. But yeah, just thought like whether DeFi protocol teams are looking towards different chains just because of certain activity going on there. But yeah, it makes sense to stay on Ethereum and Polygon because most of the activity is here as well.
That's right.
And
That's
yeah,
right. Yeah, and especially
yeah,
like with the V2, we are focusing a lot on the privacy side of things and how to do things in best way
makes
possible,
sense.
because we're bringing information also from Web2 interfaces. And for that, I think we're realizing that some of those ecosystems will provide better solutions eventually. Even Polygon, I think they're going very strong with their zk EVM solution, and they're bringing other partners onto the ecosystem to create a similar layered privacy solution. And yeah, I think that will be one of the determining factors for us. And to your point, I think each chain specializes on certain type of activity, certain type of partners, and maybe lenders. So as we find natural fits, we will probably go on more of those chains. We didn't want to do it purely because we're getting grants from those chains. Like a lot of protocols, unfortunately, I think they're very grant focused, and wherever they get grants, they just go and build on those chains. If there's little utilization, we want to be a bit more mindful about where we have exposure and where we do not create unnecessary risk also, or security exposures as well. We're very focused on maintaining security and risk as tightly as possible. Having seen even the best protocols can get hacked, right? Like the IGEN guys, that's one of the probably best out there, and even that can get hacked, right? So we're trying to limit our exposure for that reason.
Yeah, makes sense. And yeah, you mentioned the huge pipeline in terms of demand for you guys. Do you guys, is it organically where ever since you guys had your press release and etc., they just start flowing in and contacting you guys? Or how does do you guys have a dedicated BD team that goes source for deals with these fintech companies and other DeFi protocols? And if so, do you guys target certain types of fintech companies to work with, maybe more in emerging markets?
Yeah, again, just like maybe our seed round, we also have been lucky on the partnership front, because a lot of our partners early on were just people who knew us in the ecosystem from the first ETH Denver activities that we have done last year, and then this year with the Announce and ETH Denver again, where we were the sponsor, and more than 22 applications being built on Huma. That was enough to create a word of mouth to bring in a lot of the demand that we're seeing right now. We don't have a dedicated BD team. We don't have any BD team at all. And we have only one person on non-engineering side. That's Zane, that also I think is on the call. She's our marketing leader, and she just started to also look into how to get in front of more of the emerging market fintechs through different channels. And we will probably attend more fintech focused events and conferences later in the year to again tell our story and tell them about what we do and how we solve or can solve their problems. But so far, again, we have been lucky not to depend on a high headcount BD activity. But maybe at some point we will also do that. It's just right now we're just getting inbound because our message resonates with a lot of people and it travels throughout different ecosystems because we also have 40,000 members on our Discord and they are just like retweeting stuff, translating stuff into their own language and posting in different forums. And that gives us enough exposure for now for the type of demand we want.
That's, yeah, holy. That's crazy. Oh my god. Yeah, I'm very impressed. Excited actually. Yeah, you guys are full dev team and oh my god. Okay. That's very cool. Yeah, I guess you guys are more or less settled on that bit towards looking towards the future of what you guys are building. I understand you guys are focusing a bit more on chain at the moment with, I mean, I do see what's happening with crypto credit where they are trying to build things which are more related to things on the ground, and you guys are also working with some fintech companies on that. So where do you see crypto credit going in the next 1 to 3 years? Maybe, yeah, if you can touch a bit on that. That don't have to be too specific since it's quite forward looking.
Totally. I think a couple of things will happen and already happening as I see it. One is the macro economy is pushing more and more emerging markets to be paying attention to what's happening in Web3 and DeFi in general. A lot of the fintechs are unable to get that facilities from their local participants and local ecosystems, and they are looking at DeFi, or sometimes the inflation rate is so high that the interest rates they're getting is nuts and it doesn't create a sustainable form of borrowing for them. So they're looking to plug themselves into the world of DeFi to access global capital. So I think that part of demand is growing. And we believe, there is a world where DeFi and TradFi merges without people even realizing, because most of the front end will most likely be the fintech front end that's compliant and regulated in local jurisdictions. There's no escaping that. There's definitely going to be isolated, probably DeFi users and degens and interfaces that are being utilized in a permissionless way. But I think most of the use for the next billion is going to come from regulated and compliant fintech interfaces, either mobile apps or regular web apps. And then a lot of the backend is going to transition to DeFi. And the transition is going to include primitives we're building, the income assets. But I'm seeing more and more assets also coming on chain. And I think that's a great thing because more assets means more cultural type, more assets means more ways of trenching the risk versus non-risk parts. More assets means more type of lenders interested in exposure to these portfolios. More assets mean more types of lending protocols utilizing different mechanisms for handling defaults and liquidation, or just bringing the right type of borrowers into the ecosystem. So there's so many, I think, opportunities once we enhance the borrowing pool, once we enhance the asset pool that's being collateralized, and once we also bring in different types of lenders. Because if you think about institutions and what they're trying to do, they're always trying to access differentiated assets and investment opportunities. If you provide them only what's available in the traditional finance world, you don't really create any real demand from the lender's perspective. But I think what we're doing is showing already that you can create a fully transparent, fully traceable loan structures with assets tokenized on-chain or off-chain. And we will see more of that happening with, again, assets of any kind you can think of. Most likely assets that used to be private in the past, I think will be the first ones we will see. And then later on, I think we will see other types of assets coming on chain as well. And I think the last one is going to be the ZK Joey type experiences. So our wallets will change drastically. I think we will adopt a kind of abstraction wallets at scale, mostly due to superior experience. And that's going to enable this credit card like experiences with built-in credit lines. And I'm most bullish about that being the future. And I'm guessing it's going to be in the next 1 to 3 years timeline.
Yeah, great. And yeah, I guess for myself, the nicest takeaway I had today was with Joey Finance, where like what you mentioned with account abstraction, and actually I never saw MetaMask as just a wallet that didn't really, I guess, like a card that didn't really function very well. And now that you say it, yeah, it makes sense to build in credit lines directly connected to the wallet, and yeah, tracking your on-chain transactions to verify your credit, create like some form of credit scoring for you to borrow against the wallet itself. And that makes a lot of sense, and definitely is the future. And also different assets to back for crypto lending. Thank you so much, both, for sharing. And I guess now we'll open up to the ground for anyone who has any questions. Yeah, you can request to speak and we'll bring you on. If you have any questions for Huma Finance. And if you are shy, you can always press the button on the bottom right hand corner to just type your question down. Yeah, if not, I think our DMs are all open, so yeah, should be fine. But thanks again for having to speak to us.
Thank you for having me and having us as a team.
Yeah, I'm just glad we got you on, because I think this is for Huma Finance. You guys haven't been doing a lot of Twitter Spaces yet, right? Three so far or so.
We just did one, to be honest. That was the one that yesterday was the first one, the first Twitter Space.
Oh,
yeah.
Oh, wow,
Yeah.
Nice. Yeah. Gosh, nice. Okay, caught you guys in time.
Yeah. So we're happy to
Yeah.
be here together, and maybe we'll have you guys on our Twitter Space next time.
Definitely, man. If we are launching a cool lending pool with some fintech company that seems worthy enough of your Twitter Spaces, we'll let you know.
That's awesome.
But yeah, personally, I've been looking around crypto lending protocols, even on Bitcoin's DeFi layer 2, etc., and nothing seemed interesting. Yeah, then I chanced upon you guys, and I was like, holy, that's actually something new and something that can benefit in terms of real world use cases. Because I guess a lot of crypto is speculation and just auto compounding and looping of, and just airdrop farmers. And every other chain I see are different decks, and rarely do I see anything that stands out. And you guys really stood out in terms of innovation and etc. So really, thank you for building what you guys built.
Thank you. I appreciate it. I think that's the perspective we try to take, which is we are fortunate enough in our lives to have built great things in the past, and we're not in a rush to solve a small problem or build some speculative asset structure or DeFi protocol to help the next trader create more leverage. I think all of our team is very keen on solving real problems, and we know, coming from fintech, like fintech is very limited itself because it depends on the banking infra that is so limited. It depends on the partners whose thinking is also very limited because they are stuck in that mode of predatory credits and business models that are unfortunately aligned with that as well. So we are so excited about the potential of the blockchain and the new technologies being built on blockchain to create a completely new, fair, accessible, and sustainable lending ecosystem. And I think with everything going in the world, this might be the part that we can be positive about. That's going to definitely create a lot of great impact. We are here for the next 10 years building, pushing things through, and until every single person has access, we will not stop. So thank you for giving us the opportunity to talk about that as well.
Yeah, great. It's great to hear. Yeah, and yeah, I guess if there's no questions, we'll just end it here for today. If you guys have any questions at all, just DM Huma Finance. They'll definitely be happy to reply. And yeah, thanks again, Erbo, for your time. It's been an hour, and yeah, very grateful to be able to speak with you. It's an honor.
Yeah, same here. Same here. We heard about BlueJ for a long time, and it's great to
Seriously?
yeah, it's just great to be meeting in this
Okay.
on this platform. So thank you so much.
Yeah. Thanks for that as well. And yeah, good morning to. Is it morning at your wherever you are? Or-
Yeah, I'm in Berkeley, California, so it's 10 a.m. Not super early,
Okay.
still morning.
Okay, great. Yeah. Good morning to you. Hope you have a good brunch or lunch. And for the rest of us in Singapore, good night.
Good night, everybody.
Yeah. Okay, take care. Thank you, Erbo.
Thank you.
Bye-bye.
Bye.